Good afternoon, everybody. Welcome back to Schwab Coaching. Our next topic is trading price patterns. I am your host, Kevin Horner. I am in for our friend Barb Armstrong today. And I'm going to be taking you through a series of charts, and we're going to be discussing price patterns, what they might mean, maybe how traders will utilize them as a means of placing entry and exit trades and that kind of stuff. And kind of getting into a whole review of a number of individual patterns that are available in the market. So looking forward to this with you all. I've got a series of charts that we're going to look through that I hope will highlight some of these key patterns that might be available in the wild at any given moment. But more than anything today, what we're going to talk about is perhaps the manner in which a trader might choose to enter or exit these trades within these patterns, utilizing these potential patterns, and kind of building an understanding of maybe what these patterns imply for us in the grand scheme of things. So with that, I'll remind you that we have our friend JB in the chat today. He's going to get to questions that I'm unable to get to, but I want to hear from you nonetheless. So please feel free to utilize the Q&A function there on the right of our presentation window to submit your comments and questions. I'll try to address those live in the moment for you as we work through some things here today. Of course, everything we cover today should be considered educational and informational. So while we're going to be looking at some specific equities and some indices as well to highlight these patterns, it's important to know that I'm not recommending or encouraging you to take trades here in any particular position, of course. So we're not recommending that even some of these patterns should be traded by you, to be honest. But what I hope to do is kind of give you all the framework maybe of what some traders will use when thinking about a few of these patterns. Now, today in particular, given the way the market's been treating us of late, we're going to see a few of these patterns playing out bearishly. So some bear flag opportunities, for example, maybe a couple of bull flag opportunities. But again, focus today on understanding what the patterns might imply and offer traders more so than anything else. Again, we're talking technical analysis when we do this. So remember that technical analysis should not be the only means of your decision making. We think it can complement your fundamental approach to investing, your overview or research that you might do from a fundamental standpoint. But we don't want to encourage you to base your decisions exclusively off of the technicals necessarily. All right, so in terms of an agenda, we're going to jump right into what's happening in the market. We're going to look at the S&P 500, and I'm going to use that as a jumping off point to get into. We're not actually going to place any new examples or anything like that today, so it's more focus on these patterns that we see in the wild here today. And I'm going to start with the look at the S&P 500. Now, we haven't had a whole lot of change to the way things looked since this morning when I spoke with you all on Trader Talk with Brent. We have noted that the SPX has stayed relatively positive. We are up that 0.5%. We've not maintained, I should say, the bounce that we got off the open today. But we have managed not to sell down any further. You'll notice if I zoom in here that today's intraday low does not exceed yesterday's intraday low. So for the time being, at least, traders will look at these last 2 days and say that at least as of now, yesterday remains the low day in our drawdown off of 61.47, the all-time high that we note from not that long ago, everybody, February 19 at 61.47. And then I'll just point out, if we go to the low that we made yesterday, right around 55.29, our return details suggest that we're down just over 10% peak to trough. Now, again, we still don't know enough as to whether or not that is the short-term low in this pullback. It is a low at this point. We just don't know if there's going to be an opportunity for lower lows. And the truth is that when you look at the action here that we've witnessed, we have been falling rapidly. My moving averages would even be considered too slow to track the downfall we've seen in the S&P 500. My orange 20-day moving average seems to be insufficient as resistance. And I say that because, as you can see, everybody, on the way down, when we broke down on the 21st, all of our highs since haven't been remotely close to the 20-day when we rolled over. So just a heads up, when I look at that and see the discrepancy between highs and the moving average, it tells me that I need a faster moving average. So if I were to alter my 20-day, and I'm going to do this rather than working from my quick change details, I'm going to make the change here in the study tool. So I'm just going to change this from 20 to 10, and then I'm going to change the color so that it stands out. We're going to go with that light blue there. So now look at that 10-day moving average, everybody. So notice there how quickly you can see that the 10-day and a shift in price action that would get us above the 10-day might be the first indication that the selling has come to an end. We haven't gotten remotely close to that. And I should also point this out. When we talk about it from this standpoint, everybody, what does that imply in terms of a potential for a bounce from here? Could we get a bounce that takes us upward into 5,700, 5,725, maybe even 5,737, which is the 200-day moving average, notably? We could actually get a rally of as much as 140 points, perhaps, and still be in a downtrend. And I think that that's notable. That says something about the speed of the selling that we've undertaken in the last 3 weeks. It's also a healthy reminder to us as traders, if we're taking counter trend trades, in this case, counter trend would be on the long side. You'd be a buyer at this point if you were believing in the opportunity for a bounce. But counter trend traders have to be willing to move on from the trade rather quickly, right? Because what are we experiencing? Well, we've got an intermediate term downtrend, and any bounce that loses steam at an area of immediate potential resistance, well, then we've got the potential for a continuation of the selling. So this will possibly present itself here in the form of a bear flag potentially over the coming few days. And I will have some illustrations of something like that here. Kevin, I got to say, I like your comment there. Yeah, maybe it's the 2-day simple moving average, even still maybe not fast enough, right? I think a lot of traders fall from the 10-day maybe to the 5-day, but your point is well-founded in the sense that the selling has been aggressive enough that you do need a speedy moving average to dictate when we may have actually had a shift. We are unfortunately quite a ways away from it, but I will remind you, in the midst of a bearish market sentiment, as we've been feeling the last 2.5, 3 weeks, you can get very big rallies. And those very big rallies, percentage-wise, can be 15, 20, 30% even, and still not take us out of trend in the shorter term, okay? So bear that in mind. Let's all try to be as disciplined as possible because we don't want to get too emotionally tied to a bounce from here and believe that any bounce is just going to lead us back to new highs. We don't want to say that with our dollars necessarily. We want to believe that that's possible, but we're only going to participate in such a fashion if we can move through some levels along the way, right? Start taking the stairs higher. And reminder, while we do generally take the stairs up, we commonly will take the elevator, the escalator, or sometimes the elevator shaft lower and very quickly. So a wonderful reminder, I think, that we have to be prepared for these things. You know, we talk all the time, Kevin, why would you be so defensive along the way here? Why did you get so start generating cash along the way? Why was that the case? Well, things started to shift and comfort started to move. I wasn't as comfortable, so we started talking about the action below the 50-day. How significant was that? Well, it turns out it was fairly significant because we have sold down pretty aggressively from 6,000 to the 5,600. So very quick to sell down 400 SPX points. That is not a small move. We got to just keep that stuff in mind, right? Okay, so there's where we stand, at least as it relates to the S&P 500 at this point today. Now, I mentioned that there might be the opportunity for a bear flag development over the coming few days. So let's talk about a couple of things as it relates to patterns. First of all, I just want to mention that the reality of price patterns is that everything falls back to the lowest common denominator with regard to technical analysis. And I think many of you know this intuitively, at least, and that is simple. It is support and resistance, and those key details come into play on just about every pattern we could possibly be discussing. And when we start talking about bull flags or bear flags, for example, these are simply the instances where we move to a new high in a bull flag scenario and then retreat enough to build the flag or the cloth portion of the flag. So let me position this a little differently. Let's go back and look. We can find a few instances in utilizing the S&P 500 where we've had some flag situations. Commonly, the flags play out over 2 to 3 weeks on a daily chart. I'm going to zoom into one in particular here. Let's just go back to the fall of 23 when we really got going in this current market environment. We needed a little time, and we had this nice push off of the October 27 bottom. And we went upward from here into right around here, and we really didn't, I won't say we lost steam because we didn't give a whole lot back, but you'll notice that we really kind of went a little bit sideways, maybe a little of what some traders might call a flag and a stiff wind, where we just kind of went sideways for 1, 2, 3, 4, 5 sessions or so. We didn't really give back in the midst of this pullback, right? The pullback wasn't a pullback. It was a window of price consolidation over a short-term period. And so we rallied nicely, 6.5% quickly over the course of, according to my line here, only 7 trading days. We added 6.5%. Then we go sideways for 5 sessions, and we have another move to the upside. Now, that should not be a surprise for us. We should look at the close here, making a high above the so-called cloth portion of our flag, and then taking it out, implying that we could move further to the upside. And from a measuring standpoint, some traders would just say, well, if you made this line here, you made this move to the upside, consolidated, and broke out. Some traders would then say, well, we should be able to make that same move to the upside from that flag. And in this case, yeah, we absolutely did. And notice that when we made that move, it was the impetus for the next leg higher, as it turns out. Now, it should also be notable, we didn't immediately fall into a true flag situation in here. But everybody, look at what happened in here. Look at this just period. I'll put a little rectangle here. So does that look like an actual flag? Can you draw it in so that it resembles kind of like this? Maybe not, but pay attention to the price action that occurred here nonetheless. Let's zoom into my rectangle, just this space enough. We didn't give back price, did we? We just went sideways. We didn't really make a new high. I mean, you have a doji followed by a spinning top, followed by a tight range day bullish, tight range day bearish, another day where we tried to trade higher, couldn't, finished positively versus the prior day close. We then got a red day where we were rejected. We tried to break out and couldn't. But all the while, we were holding that very speedy, this is the same 10-day simple moving average. And so, again, what I want to bring us back to, it can be as simple as support and resistance. Understanding that a bull flag is simply giving you a consolidation window after a lengthy run. Sometimes it's not even a lengthy run. Sometimes it's a one-day spike because the earnings were so tremendous on the stock, right? So it does not have to be perfect, and rarely, in fact, will these patterns present themselves in such a perfect fashion. But ultimately, lean into generics and support and resistance. Let's not go too far down that path towards believing that everything we see in terms of price action needs a clearly defined pattern. That's not necessarily the case. So try and be a little bit more broad in the way that you view these patterns and the potential for these patterns. So I've got a couple, I think, that are outside of the S&P 500 that we could look at in here. But before we do, I'm going to bring in another chart here, or a whole new grid in just a moment. But check this out. I mean, just looking along the way, you can see we've got rallies. Whoops. Let's do this again with just another line up. Rally and then drawdown. Quick drawdown to or retracement to the moving average, right? Rally and then drawdown. Okay. Yeah, did we get this one questionable day? Sure. You're going to get some questionable days in the midst of this. But in the runs that we've had, moving along the pattern, you get breakout and slow pullback, breakout and slow pullback. Here's another one, prime example. Breakout and then a cleaner flag right through there, right into the 10-day moving average yet again. So in the midst of a strong uptrend, bull flags like this will present themselves frequently. In fact, I think it's one of the axioms that I've read about way early on in my technical analysis education is the idea that in the midst of an uptrend, bull flags beget new bull flags. So you make one, you consolidate for 2, 3, 4 days, you make another move, consolidate for a few days, make another move, consolidate, pull back to the trend line, over and over and over again. Okay? So there's a lot of consistency with these types of draws or these types of patterns in the midst of a longer range trend. Okay? Now, that bull flag scenario can absolutely play out the opposite way, right? And that is what we were talking about with the potential for what's going on right in here. If we look at when the selling really got going in earnest, I think a lot of traders would agree that it's somewhere in the vicinity of about that 6,000 level, right? And so if we just looked at it from here and drew that line down and said, well, how far could we rally and create this upsloping flag? Remember, we have the creation of the cloth portion of our flag typically over the course of between 3 days out to as many as maybe 12 to 15, right? So maybe as little as 2 to 3 days to as long as maybe 3 weeks when we think about it on a daily chart. The truth of the matter is, though, that this happens in all time frames, as do many of the patterns that we talk about. The fractal nature of technical analysis tells us that we can look at this on a daily basis and we can find these patterns. We can look at it on a weekly basis. We can look at it on a monthly basis, yearly basis. We can find these exact same patterns as we could if we looked at it at 5-minute bars or 1-hour intra-period bars. We can still find all of these scenarios playing out. Now, one other note about flags as it relates to things here, at least, is that there's another common axiom that some traders choose to employ. It's one that friend Pat Mullally used to talk about with me frequently. He used to say, you know, flags tend to fly at half mast. So what does that mean? Well, it means that when you look at a move one direction, when we've got a fair bit of selling, in this case, how big a move back to the upside can the bears take on and still be in control? Well, one of the ways that some traders will think about that is with a 50% Fibonacci retracement. So if we called this the ultimate peak, I'm just going to edit that to red just to call it out for us. So this was our peak from which we created our flag pole. That's what I've got in white. And if we fell that distance, How much of the fall could we make back and still look to move lower? Or that is to say, still have a downtrend in place? Well, this is really interesting as it relates to the S&P 500, because check this out. Look where that 50% level is, everybody. 50% of the entire selling move from our failure at the six. Let's move that up just a little bit. I'm just going to activate this and I'm going to move it to 6,000 because there was a lot to believe in the round figures at 6,000. Okay, so just from a standpoint of 6,000 offering us resistance, you can see we had a tail that came close, a tail that went through it, a tail that came close, another tail that came close. We're just going to use 6,000. So where is that 50% level? It comes in at 57.62 ballpark. Okay, so notice my red resistance line, right? This Fibonacci draw tool it gives us the impression that we could rally all the way up to about 57.50 to 57.60. We could meet resistance there, and that could be our next lower high, right? Because we've got a lower high first, right back here, right there. And then we had another one. Unfortunately, it happened rather quickly right there. And so even if we got a wonderful rally, and let's be honest, if we pushed from 55.25 to 57.25, we're going to feel really good. We added 200 points. But does it mean that we're out of the woods? Are we back to a bullish trend? Unfortunately, if we don't trade above that down sloping aggressive 10-day moving average, we probably aren't yet in a new short-term trend. And so what's the takeaway from something like this, everybody? My hope is the takeaway is, hey, let's not get bogged down by the very quick price action that a bounce from here could represent, but let's be prepared that we could lose steam at this confluence of the 200-day moving average, the 10-day moving average, down sloping into it, and the 50% retracement of this potential bear flag pole I've drawn in. So, Brown Buffalo, great question. Why not just go to the 200-day moving average? That's entirely right. I mean, it's right there. We just have to admit that it could be that zone of potential resistance, right? Absolutely could be the 200-day, could be the 10-day. It could be that 50% retracement. We just don't know which of these is going to carry the most importance for traders if and when we get back to that level, right? We don't know. So what I can tell us is that this rectangle takes into account price action at these levels, takes into account the 200-day moving average, the 10-day moving average down sloping into it, and the 50% retracement. All of that is confluence of data at the same level. That strengthens that level from an importance standpoint, right? It tells us quite a bit. Okay. Beauty at its best, I'm using, in this case, that is a 10-day simple moving average. Not exponential, just simple. Taking the last 10 closes and adding them all together, dividing by 10, that's creating that line. And of course, that means that today's action will have impact on that line. If today turns green and we can trade on a close through the high from yesterday, that's certainly a positive for us if we can get that development. But ultimately, price has to cross the 10-day moving average to the upside to see something different than we have seen since February 21st, right? Good old JB. Wouldn't be JB if he wasn't giving Kevin a hard time in the chat. Love to hear that. All right, so there is at least a concept associated with flags that I want you all to take away. We looked at it from a bear flag standpoint. We have defined our fall. Do we know if the low is our ultimate low? No, we do not. But we are hopeful that we are in the midst of a bounce off of a short-term low. And we now have a thesis as to where that needs to move in order for us to feel more bullish about this being more than simply a relief bounce. So a relief bounce can happen. It can take us into the 200-day, and we can still fail, roll over from there, make a lower high followed by a lower low. That is what we don't want to see, but that doesn't mean we shouldn't be prepared for it, right? So keep that in mind, everybody. So here we've talked bear flags. Yes, we've used the S&P 500. My hope further is that incorporating current price action and giving us a thesis to consider for the coming 2, 3, 4 sessions here can be a helpful development for you all in understanding how that bear flag could play out. Now, we call it a bear flag, of course, because as we run ourselves into resistance, the expectation from there could be the rollover or the roll lower from that spot. Okay, so we are going to bring in some additional charts that could also offer both bull flag and bear flag opportunities. But I'm going to pause on the flag discussion, and I'm going to bring in this alternate grid and talk about one other price pattern that I do think is important. And that pattern, believe it or not, is a consolidation pattern. Okay, so here we're looking again at the S&P 500. This is a long-range view that is not current. I have built this from essentially the beginning of 2014 through the summer of 2016. So we've had a pretty, in this window, a relatively tight range with a number of other trends in the midst of it, right? We had a nice uptrend. You can see we were trading above. Outside of this here, we were trading above our 200-day moving average. And then we were here below it, and we were struggling. But ultimately, trading in a range from 1,800 on the low end to about 2125 on the up end. So about 325 SPX points. First of all, for those of you noting the values here, SPX at 2200 as recently as summer of 2016. That's not that long ago. I know it's already 9 years, but my point is that we are talking about levels in the SPX today that are 6,000, 5,500, 5,600, etc. So it's easy to see, in hindsight, it's easy to go back and go, oh my goodness, we've really pushed the SPX higher. But the nice thing about a range, when you find it, everybody, is that the range can lead you to the next opportunity, right? So I'm looking at this one, because I had to find it on the chart. I needed to find a week where we had this available, a weekly viewpoint, and you can see where we went really essentially sideways for the entirety of that period. Again, January of 16, essentially, all the way through, January 14, all the way through summer of 16. So 2.5 years of going sideways. And then eventually, you'll notice there that we busted out of it with this candle. Now, I'm going to go ahead and add some additional time to this. So I'm going to go to July, and I'm just going to push this out to the end of that 2016 year. Hit OK. And now what you'll notice is we broke out of that range with this price action, and we made new highs. Right to here. Good stuff, right? We love making new highs. But did we only go higher from there, everybody? We did not. What did we need after having broken out? We needed to pull back and get a test, right? We needed a test of an area of potential support. And in this case, that test happened to be that 200-day moving average in blue right here. So we did have a fair bit of give back. In fact, bullish traders would have said, boy, Kevin, we should have held up right in here. And I would have agreed with you 100%. We should have, but we didn't. Because why? Well, remember, you have a range and you have prior resistance at these highs. Resistance, let's go back to technical analysis 101, everybody. Resistance, when broken, can then become support. Well, we dabbled with it a little bit in here, didn't we? We tried to hold support, and it just didn't maintain. We broke down, found it at our 200-day moving average, and then we got excitable and aggressive, and we pushed off of it once more. Now, if I were to look only from this point on, I'm sure you all can see it. You guys see the next bull flag on this pattern? Give you all about 5 seconds here. I'm sure you do, because we just got done talking about bull flags and how they work. Nice moves from lows to a new short-term high. When the buying stops, we consolidate kind of quickly, right? We go either sideways or down to an up-sloping, supporting moving average. In this case, a 20-day moving average. So we could draw our line from maybe here to our peak right about here. I would say that's the second bull flag in this rally. Here's the cloth portion of said flag. And then if I was looking back, this one may spot a little bit tougher because of all the tails involved. But notice here, there it is. Pretty much got the same thing right there, right? So one bull flag, very quick, only 2 to 3 days sideways before continuing. And then this one pulled back about 4 to 5 days. And then now you've got your opportunity for continuation. Now, the one thing we haven't talked thus far is how do we traders, bullish traders looking at a bull flag, how do we use this to our benefit? Where do we take our trades? Well, if you didn't buy at the ultimate bottom, and who would necessarily fault you for not being a buyer on a kind of a gravestone doji day sitting on support, I could understand it. But here you moved higher, consolidated for 3 days. What are we looking for? We want a new high close. If you were looking at this bull flag and saying, I am going to wait for the bull flag to break out and then I will take position, it was this day that a trader might have added to their SPX position there based on that bull flag, right? So 1 day closing at a new high after generating the flag, is it an aggressive entrance for some? Yes, it is. Not everybody is ready to join a newly developing uptrend on day one or even day two. Some of you want confirmation, understandable. But some of you need that opportunity and recognize, well, I might not put on my full position there, but I want to get started there. And so I want to do so with 25% of what I want to own, and then I'll take it and go. And if it continues higher or I make another new high, I'll add another 25%. And then if it develops another flag, maybe on the next breakout, I'll add my remainder. So based on that, everybody, we had this day as our breakout from this flag. What about the next one? Bet you all can see it here. Boom. The day outside of the downtrend line. Okay. So some days it pays and behooves you to get in right away. Other days it pays to be patient. And the trouble, of course, inevitably is we don't know which of those scenarios is likely to play out, right? So this is where it all comes down to trade management. How do we as traders step into our position? How do we add to the position? How do we take advantage of what we see developing on our charts? Okay, so I'm going to let's go forward here for the few examples and see what we've got on our chart. I've got a Broadcom here, and we are in the process of a pretty healthy retreat. So we have come down to the 200-day moving average, and we could be setting up bear flag potentially here, right? We, again, don't know. Often, it will look as though we're setting up a bear flag until we move through one of those important levels along the way. So if I was looking at the AVGO position, Most recently, we went sideways at this resistance for about 2 weeks. So let's draw the Fibonacci from here, everybody. Let's just do this. And again, I'm not suggesting that the Fibonacci is your only opportunity, but it can give you a guideline. And further, while we believe that some traders lean into that 50% retracement, it should be noted that from a standpoint of the Fibonacci, some would tell you that it could rally as much as 61.8% before continuing the downtrend that we came into this with. Okay, so have a level, have a thesis more importantly than anything else, everybody. Maybe you want to start with the 50%. Maybe you want to go ahead with 61.8. Maybe you want to stay bearish as long as it doesn't get above the 38%. My point is simply pick a level or something like it that's going to give you the inkling to either take position, sell position. Remember, trading is all about probabilities. And so having a thesis of what you think can happen and how you're going to address the trade you're considering based on price action, that's the most important aspect to trading, in my opinion. That's the one opinion I can offer you. By writing it down, giving yourself that playbook, and then just simply referring to that playbook, what I can't give you is the clear definitives about what you should be relying on, what details should make the most sense, because we are all different traders, right? The things that make sense to me don't make sense to everybody necessarily. So have those concepts well defined for yourself, and it will benefit you as a trader. So we've got some work to do. Could Broadcom be just simply bouncing off a very important 200-day moving average and get right back into things on the uptrend that it's been working from for quite a while? You'll notice this test of the 200 wasn't the first, right? We tested it back here and held and went higher. We tested it back here, held and went higher. So the reminder should be, well, it works because it's worked in the past until suddenly it doesn't work, right? So working until it doesn't work is the key reminder here. Traders try to stick with what's working until it doesn't. Okay, so we haven't been, as of yet, at least on Broadcom, haven't been proven that we no longer can hold the 200-day moving average. So for a lot of traders, that becomes an excellent zone of short-term support. All right, moving on. What else do I have in here? Okay, here's Mondelez. Mondelez making a strong push. Made a nice move off of this $54 low, up about 30%. No one should be surprised with a bit of a give back here, right? Now, it's nice if it can give back and hold the trend line that it's been above the whole time, the 20-day moving average in orange. Now, why is that important? Let's just go back to some technical analysis 101 stuff. 20-day moving average all the way down. I mean, look at how tightly we're talking, everybody. Right into it. Right into it. Through it, but not holding it. In fact, some dabble in here before we made this low post earnings. A very weak open, a flush out open, in fact. One where traders look at it and go, excellent. We got down so oversold that everybody wanted to step into it. And not only that, but you had a nice little bullish divergence at that last low, right? Because you got new low in price, but RSI made a higher low. In fact, the second higher low in the series. So that was an interesting spot. And the window where it recaptured the 20-day became further interesting because it recaptured, held, and then strongly moved upward yet again. So 20-day was resistance. Now perhaps the 20-day could provide support. And if we simply expected, if we simply expected that to be the case, well, then we want to make sure that any retreat does not exceed our 20-day moving average. Now, chances are it could give back even further here. It looks like we're developing a little bit of that flag, right? So ultimately, the trader wants to see you trade above the downtrend off the peak to get you into a new position like that, right? So there's a potential bull flag on Mondelez here. Let's see what else. Got Biogen, maybe a little tighter in its process, but ultimately a strong push. 22% finding support along a zone that has previously been support and a 20-day moving average, right? So listen, not all of them are going to look fantastic, but that should not dissuade us from giving some consideration. Lots of work to do on Mondelez because we can note the difference between our current price and that 200-day moving average, everybody, which obviously is quite a ways away. We're looking at about a 40-point move just to the 200-day moving average. And so, again, try not to be bogged down by our titling of these patterns because, again, can be as simple as, did we run to resistance? Did we find support? Right? It doesn't have to be very difficult. Anybody surprised by this candle being the point where the buying stopped? I mean, just check it out. It got through this last candle and then got a major rejection. So intraday enthusiasm pushed back, right? And now we're hopefully setting up a higher low here. But you've been in the midst of a pretty healthy downtrend. And speaking of said downtrend, I would imagine some of you can see a bear flag. This one a little lengthy, but still a bear flag. That, what did it do? It broke bearishly. Oh, we got another bear flag, rallied into resistance, broke down bearishly. Oh, we got a little bear flag. We rallied into resistance. And yet again, we broke down bearishly. I could continue, but I think you're taking the point, right, everybody? Just moving down. Every bounce into resistance is the cloth portion of a bear flag. Now, if you didn't know it was a bear flag and you just said, boy, Kev, you've just been running into resistance at the 20-day, I think any rally I bought, I should sell at the 20-day until that no longer holds. And even back here at 163, you would have been doing pretty good for more than a few weeks on just that thought process based on what's been going on since here, right? And now things are starting to change a little bit. Maybe there's something new developing there. Okay. All right. What else do I have? Caterpillar. Okay. Caterpillar, big bounce up to resistance. Got through the 20-day moving average, but not with any real conviction, did it, everybody? One day above it, day two, right back below it. You couldn't even get the Horner rule to hold here for you, everybody. One day above the 20-day, day two, right below it. Day three, banging our head on the 20-day. Day four, banging our head on the 20-day, right? For some of you bearish traders, you would look at this rally as being over because you're outside of the uptrend line here. Some traders could position themselves based on this alone, right? And maybe they look at the level we just created with the highs of the last 2 days and they say, I'm still feeling bearish as it relates to Caterpillar. Again, this is not a recommendation. This is not what I think is going to happen. But based on the trend analysis, they're looking at this flag rally into resistance and failure to this point. And the trader might just say, yeah, over 345, my bearish thesis is losing teeth. Ultimately, if we made a high through these highs, there's no reason to be bearish, at least not until we find some other method of rejection. Maybe that, going back to one of those new words for some of you, confluence of the 50 and the 200-day moving average right there. But I could absolutely see some traders, bearish traders, looking at that white line and saying, yeah, man, I've got a chance for risk of maybe 5 to 6 points, right? We would cover a bearish trade if the stock closed 6 points above or 6 points above where we are right now. And they could be targeting the lows we just made at around 320, which means they'd be risking maybe 5 to 6 for the potential to make upwards of 15 to 20. So from a risk to reward standpoint, a proper view of things. So we have covered quite a bit, but I wanted more than anything today to try to eliminate, as much as I spoke about bull flags and bear flags, eliminate the concept of defining them as such and paying more attention to support and resistance and the trend analysis that many of you are already doing. Okay. And so my hope is that when you take a look at these again, you're going to say, yeah, that could be a bear flag. Yeah, that could be a bull flag. But let me just look at it from a brass tacks level. Where is resistance? Where is support? Where am I going to change my current thesis? And further, what does that change in my thesis mean in terms of implementing trades that I want to make? All right. Have a plan, stick to the plan, trade that plan. All right. Okay. We're going to wrap it up there, everybody. Much more to come from us, obviously, for the remainder of today. Big thanks to my man JB there in the chat. I know he's going to be back with you all a little later today, if I'm not mistaken. So let's see. We got James for trading growth and value stocks today, this afternoon, after we hear from both Cameron and Ben today a little bit later. So up next, Cam with getting started with Thinkorswim. And then we're going to have market and sector analysis from Ben. And then you get to have JB this afternoon at 2 p.m. Mountain, 4 p.m. Eastern. So make sure that's on the chat, on your calendar, everybody. As always, I love hearing from you. If we didn't get to your question, Isaiah, let's see. You were asking about the retracement zone, the 23% level of Fibonacci. Yeah, it is a common spot in the midst of a stronger trend. The question becomes, is your draw beginning, the beginning of your Fibonacci draw, does it line up with the way institutions are looking at things, right? Some institutions might look to that COVID low and draw that out on the SPX. That could be a way that some institutions are developing their ideas. Others might be using other instances, right? Remember, the SPX has had a number of those levels off of which we've made strong momentum moves. So picking the right move beginning is as important as anything else in that thought process, Isaiah. I know I didn't give that enough color for you, but hopefully that serves to answer. Again, I got to wrap it up, everybody, but thank you so much for being here. Follow JB and me on X, James Boyd CS and Kevin Horner CS. And of course, keep it tuned right here to the Schwab YouTube coaching channel. Thanks, everybody. I look forward to seeing you all again real soon.